All right, so we're going to take a look at a classic tasty concept that we've kind of put a little bit of more teeth, more meat on this research. So we're going to talk about the in the money percentage versus the probability of touch percentage. And now we know that historically, we'd say the pot is twice the pop, right?
Sure, sure.
Or I'm sorry, probability of touch is twice the probability of being in the money, or whatever the delta is, right? Which is 1 minus pop. The question is how well does that hold in terms of the 2-to-1 relationship that we have kind of quoted in the past? And on top of it, for different underlyings, does it also hold? Because a lot of the studies we did were for SPY. So the question is, does this hold for, other indexes, for different delta strangles too? Like, is this consistent for 10, 20, 30, 40 delta across the board, this 2-to-1 relationship? And if it does differ, how much does it differ? Just to put some more context around a very classic tasty concept.
Okie dokie.
All right, so we're going to take a look at a lot of math, and Jacob likes to put a lot of math into it, which I appreciate. But because of this property called the Markov property, I'm not going to go into it, but we know that the in the money percentage, so the probability of expiring in the money, or basically close to the delta, should be about half of what the probability of a touch is. Okay, so basically, kind of the classic, intuitive example is if you have an at the money option, delta is 50, probability of expiring in the money is 50. What's the probability of a touch? Well, it's 100% because it's already touching, right? So that's kind of your classic example. And then it kind of goes down from there. This should be skewed. This property should be skewed because we do have this put skew that kind of makes this market imbalance. We have positive drift in the market, so puts have skew, calls are discounted, but IV is priced to the downside. So does this property still hold even with this skew? And what about other indexes?
Yeah, and you're right. Jacob did go into this from a very this is a much higher level. I prefer. He really did get into the numbers, yes, 2 days ago.
Yeah, and this is, we'll just kind of basically digest what I think personally matters as a takeaway.
Yep.
So let's go to the next slide. And we're going to take a look at the actual study. So we're going to use SPY, IWM, and QQQ. Now, all of these do have put skew of varying degrees. These all have various volatility. SPY, obviously, the lowest of the bunch. IWM would be pretty much the highest IV of the group. They're all equity indexes. We're going to examine the individual option legs. So we're going to do the 45-day options, 30, 20, and 16 delta puts and calls. Okay, so we're doing everything here. For each option type and delta, we computed the probability that the strike was tested, which is the pop, or the pot, the probability of touch, and then the frequency, or the probability that the option expired in the money, essentially close to the delta, right? So this is where very simple study, realistically speaking, probability of touch, probability of expiring in the money for all of these options. Okay?
Yep.
SPY puts. We're going to start with the puts, 30, 20, and 16 delta. So if you look at the 30 delta puts, probability of a touch, 37%. Probability of expiring in the money, 20%. That's very close to 2-to-1. You look at the 20 delta puts, 25% touch, 13% expiring. Again, essentially 2-to-1. And then the 16 delta puts, a little bit more skewed, but based not by much, not any discernible amount, still very close to 2-to-1. Which is very cool to see the math work out.
Sure. And then this is what if somebody were to tell me a delta on something was 30, I would say it has a 60% probability of touch. I mean, we've always looked at this 2-to-1 type of ratio back of the envelope just quickly, as something that we've done throughout our trading career. And that happened, very early on in our trading career.
Right. And the reason for these being lower than you'd think is, again, because this was done with real data. And over the last 19 years at this point, we've been in mostly a bull market. So of course, you're going to have the theoretical be a little bit higher than what actually happened on the put side because you had a bull market. But still, the relationship between the probability of a touch and the probability of expiring in the money is still 2-to-1, even though the theoretical numbers were both higher. So, and then the same thing for the 20 and 60. So let's go to the next slide. We're going to take a look at the IWM puts. Again, essentially, listen, when we're comparing, margin of error in research, when you get to a point where the 2-to-1 relationship is like essentially dead on for everything, that's a pretty good study. That's a pretty good test case. Right?
Yeah.
So again, essentially the same numbers for SPY. Again, these are puts, so they're going to be a little bit lower in terms of the probability of hitting because everything's gone up. But again, 2-to-1 relationship holds for essentially every single strike, off by maybe 1 percentage point for every single strike, which is pretty remarkable. Let's go to the next slide. Take a look at the QQQ, I believe. Yes, I mean, I can't make this up. Basically 2-to-1 for every single strike. Now, again, these are the QQQ probability of expiring in the money puts will be the lowest for all the major indexes because QQQ has gone up the most in the last 19 years. So that again plays into it. Now, again, this is not saying this is what's going to happen in the future, these specific probabilities, but we are saying that the relationship between the touch and the expiration probabilities are going to be 2-to-1 almost all the time. Okay, we're going to look at the calls this time. The calls obviously were higher, right? So because of the skew, right, the actual probabilities of being in the money were higher than theoretical. And because of that, the relationship between the probability of a touch and the probability of expiring in the money wasn't exactly 2-to-1. It was more like 1.5-to-1. Again, because there's been such pull to the upside that if you're going to think of it this way, the probability of expiring in the money for a 30 delta call was actually 46%. Chances are you're going to touch it essentially over 50% all the time, and that's
because that's not a closing over, that's just a touching.
Exactly. Again, the calls were more like 1.5-to-1 because of that huge move to the upside. Again, I mean, bull market, and we can't really cherry pick the data in this case. We have to show it what it is.
Sure.
So if let's say you're betting on a bull market, then you kind of want to expect a 1.5-to-1 relationship with the probability of a touch on the call side.
Yep.
Let's go to the next slide. Same thing with the calls on the Russell. Basically 1.5-to-1 times greater probability of a touch than the probability of expiring in the money. Again, these were pretty interesting. Again, the QQQ moved the highest, had the highest move to the upside, and those 30 delta calls actually essentially expired in the money 50% of the time. That's kind of interesting.
Yeah. Much higher, but that's because of the movement that we've had in the NASDAQ over the time period of this.
I mean, that would be, if you knew what to trade, if you knew these results in 2005, you wouldn't ever be selling put. You wouldn't do anything but buy those calls, right?
You wouldn't still be here in 2024.
Yeah, no. So in theory, the probability of a strike touch during the life of an option should be about double the probability that the option expires in the money. To the downside, it's played out to a T, but to the upside, it was a little bit skewed because, again, all the movement was to the upside over the last 19 years. For me, the takeaways are if you're going to trade puts, the relationship holds exactly what you'd expect. If you're going to trade calls in equity markets, unless you're going to have a bull market like we had, you're also going to have very similar results that you'd expect.